Over the past decade, as private equity firms like Blackstone, KKR and Carlyle Group have grown into a gargantuan size and raised buyout funds nearing or eclipsing $20 billion, one critique of their cash gusher was that it would inevitably drive fund returns lower. Now, as the US economy emerges from the coronavirus pandemic and markets soar to new record highs, recent earning results from America's big buyout firms reveal a trend of rising returns even as funds surged in size. Fueled by piping hot financial markets, returns from the flagship private equity funds of Blackstone, KKR and Carlyle are on the rise. Mega funds from these firms that recently ended their investment period are all running ahead of their prior vintages and raise the prospect that PE firms can achieve net investment return rates nearing or exceeding 20%. Carlyle, which reported first quarter earnings on Thursday morning, is the newest firm to exhibit rising performance. Its $13 billion North American buyout fund, Carlyle Partners VI, which was launched in 2014 and ended its investment period in 2018, is now being marked at a 21% gross investment rate of return and a net return of 16%, or a 2.2 times multiple on invested capital. The fund has realized $8.8 billion of investments, like insurance brokerage PIB Group and consultancy PA Consulting, and sits on a portfolio marked at nearly $20 billion. The returns are 2 to 3 percentage points ahead of Carlyle Partners V, the flagship buyout fund it raised just before the financial crisis. That fund is on track to earn a net IRR of 14%, or a multiple of 2.1 times its invested capital. Rising fund profitability, even at scale, is helping to fuel Carlyle's overall profitability. Net accrued performance fees from Carlyle VI ended the quarter at nearly $1.4 billion and Carlyle sits on a record $3.2 billion in such performance fees that will likely be fully realized in 2021. The firm's once lagging stock has recently risen to new record highs. The trend is even more clear at Blackstone and KKR, which have both used spongy IPO markets to realize multi-billion-dollar investment windfalls in recent months. Blackstone's flagship $18 billion private equity fund, Blackstone Capital Partners VII, was closed in May 2016 and ended its investment period in February 2020, just before the COVID-19 economic meltdown. After taking public or exiting investments like Bumble, Paysafe and Refinitiv, this fund is now marked at an 18% net investment rate of return, 5 percentage points better than its prior fund, which raised in the aftermath of the 2008 crisis. In the past 2 quarters, the fund has been the single biggest driver of Blackstone's record profitability, generating over $1.6 billion in combined accrued performance fees. In the first quarter, the fund was responsible for 82 cents in quarterly per share profits, filings show. Overall, Blackstone sits on a record $5.2 billion in net accrued performance fees.